Hello everyone. Hopefully you can hear me now. Sorry for making you wait. We just thought that we will start the session a little bit later to wait for more people to come in. So I think we can start the webinar now. So my name is Ellen Yum and I'm the marketing manager at DTE. This webinar is a part of a series of activities for knowledge sharing that we do for businesses to support them during the coronavirus pandemic, including news and updates and complimentary one-on-one consultation, as well as webinar on featured topics like this one. This particular webinar we're co-hosting with specialists from WHN Solicitors and Lloyds Bank. Our aim is to help you understand the various aspects when it comes to demerger, such as financial, legal, and banking aspects, so that you can think about them when if you're considering demerger for your business. Throughout the session, if you have any questions, please feel free to pop in the Q&A box below, and our speakers will keep an eye on that and will answer live or type in the answer. So now, without further ado, I would like to introduce the first speaker, who is Fiona O'Loughlin, our director in the Accounts and Audit Department at Demerger. Fiona, could you please unmute yourself and turn your camera on? Over to you.
Right. Good morning, everybody, and thank you very much, Ella. Generally, I seem to be seeing more demergers happening in recent years. I've tried to think about why this might be. Maybe 10, 15 years ago, I didn't see very many at all, they're quite rare. And then maybe in the last 5 years, and then more recently in the last couple of years, we're seeing a lot more. I'm not too sure that I really know why. The only thing I've really tried kind of come to the conclusion on is that maybe after the financial crash in 2008, more businesses tried to diversify in an effort to maintain their profitability and their competitive edge. And so they now find themselves with maybe 2 or 3 divisions in their company, and some of which may be more successful than others. But that's just my thoughts. Other people might have a different view on that. So in general, though, as businesses grow and diversify, we see distinct divisions develop. And in many cases, they can continue to operate side by side within the company. But in some cases, we do see a need to separate those divisions out into new companies. Now, in practice, we probably see 3 common reasons why businesses demerge. And the most common one at the moment are where business partners want to go their separate ways. Now, there could be a number of reasons for this. They could have they run different divisions and have different visions for those divisions that they're running. Or in some cases, we may see that business partners just simply fall out. This can be dealt with by one shareholder buying out the other shareholder, but in some instances where they're actually responsible for 2 different divisions of the business and they both want to continue to run those divisions, a demerger will allow them to do that and go their separate ways. Ella, could you just pop up the first diagram, please? Right, so in this scenario, pre-demerger, we have 2 50-50 shareholders owning a business that might have 2 distinct divisions. Now, following a lot of statutory paperwork, legal documentation and HMRC clearance that others will discuss later in this session, we end up with a situation post-demerger of 2 distinct groups with each shareholder now owning 100% of a new holding company, which in turn owns 100% of a company with that distinct division. Thank you, Ella. The second scenario that we see a demerger happening in is with a business sale. Now, the vendor may wish to retain a certain division or an asset within the business, or alternatively, the purchaser may only wish to buy a certain aspect of the business. A typical scenario that we see is where the business owner wants to retain the business property. So, Ella, can we have the second slide, please? Right, so under this scenario, we have a shareholder with a business that has a premises and a manufacturing business. Again, we need the clearance from HMRC and the legal and statutory paperwork. And post demerger, the shareholder will then hold two distinct divisions with a holding company and the manufacturing business, and then in this scenario, the holding company and a business that owns the premises. Thanks, Ella. So now the third reason that we see a demerger is often for asset protection or risk management. Certain assets, often the premises, can be shielded from risk if they're demerged into another company out of the trading company. Similarly, divisions can be demerged to protect those divisions from the risk of insolvency if one of the divisions of the business could potentially bring down the whole company. So in this scenario, I've decided not to do another diagram because you've probably got the idea now. What we end up with is similar to the previous situations where each division is separated out into a new little group of companies with the shareholder owning a new holding company that then subsequently owns the demerged division, or the demerged division that includes the property or the different distinct elements of the business. So those are the three reasons that we see principally for demergers. And that's probably all I've got to say at the moment. If anybody's got any questions, please put them in the chat box, and I'll hand over to George.
Thank you, Fiona. So as you just mentioned, if you have a question, particular question about your own scenario, please feel free to put it in the Q&A box, and we'll keep an eye on that. And the next speaker will be George Lowell, our tax partner at Demerger, who will be speaking about tax aspects around a business merger. George, could you turn your video and microphone on, please?
Yeah. Can you hear me? I can't start my video. It's saying, oh, there we go. There we go. Right. Morning, everyone. Yeah. Now, thanks to Fiona for giving a good summary of the key main reasons why we often have clients approaching us and saying that they would like to split their businesses or assets out of the same company into different companies for different ownership for whatever reason that might be. And once we've reached that point that a demerger looks like what is required for a commercial and practical objectives, often the next question is, well, how do we do that? And obviously there are lots of things we need to think about. Tax is one, the legal aspects that Paul will talk about are another, and the financing and other aspects that Andy and Amanda will talk about. But the tax is often one of the most important things, because just by their nature, businesses are valuable, and properties, if we're looking at a demerger to separate properties are also very valuable. So any time that we're moving shares, businesses, land and buildings around, the values are often very high, and also the number of taxes that can apply there are several. So if Ella could please start and share my first slide. What I'll start to do, I've only got 2 slides, but the first one is just to talk through or identify at a very high level the different types of taxes that we need to think about. Not all of them might be relevant in each case, but in most cases, well, getting on for all of them are. And the first one, capital gains tax for both the shareholders and the companies. I mean, if you think about what we're trying to do with the demerger, is to split all the assets or the businesses that are owned by one company, and that company being owned by its group of shareholders, to split that into more than one company that might be owned by the same group of people, or it might not. We might be looking at a partition type demerger where one group of shareholders wants to own one set of assets or one set of business, and the other set of shareholders want basically a clean break, and they want to take a different part of the business and different assets into their company. And obviously moving those assets around can potentially cause capital gains for either the shareholders and the companies, depending on what we've got and how it works. Income tax is also another one. Mainly this is obviously for the shareholders personally, because as I'll briefly touch on the different types of demerger, or the mechanics for making a demerger happen. And one of those can be using a distribution or a dividend in specie, effectively, of the assets to the shareholders. Now, if a company transfers an asset to its shareholder, the starting point is, well, that's a distribution of that asset to the shareholder, and without any rules to prevent a tax liability, that would be subject to taxes, income tax on the dividend. So again, there needs to be rules to relieve that and ways around to avoid that corporation tax hit. When we're looking at the businesses themselves, obviously the corporation tax aspects of moving assets around in companies, or whether it's moving divisions and properties. So there are, again, specific rules for transferring stock, capital allowances, pools and tax losses, all of which, I mean, again, there are relieving aspects to make this all flow as smoothly as possible. But in certain cases, there are tax hurdles to get over. But so we need to think all about those. And then our old friend VAT, again, it's easy to kind of whiz over, not necessarily forget it, but just need to keep a careful eye on VAT. In many cases, the transfer of a business or a division from one company to another will qualify as a transfer of going concern. And if that's the case, all those conditions are met, then that's great, because that takes it out of the VAT net. But perhaps probably the bigger one in many cases, the real concern, again, with the values involved usually being quite high, is properties, where if we've got commercial properties that are being moved around, we need to look at options to tax. Is there one? Is there going to be a VAT issue as we move that property around? And finally, again, stamp duty and SDLT, we're typically talking about moving shares, possibly properties. And so while we talk about, there are reliefs available both in the stamp duty and the SDLT rules, and we can go for approval from the HMRC after the transaction. We need to think that all those conditions for the reliefs, where we're moving a property or moving shares from one company to another, that those conditions are satisfied, because again, the amounts can mount up pretty quickly. So the tax issues, the range of tax issues that have to be thought about on a demerger are pretty wide ranging. It's almost like a mini case study of almost every type of tax that you can think about in many cases. And there are rules that generally allow these to happen tax neutrally, and it's just knowing which ones to pick, and the ways around, the tools and techniques available to us to make sure that there are no tax bites in the cake. Okay, so if we can move on to the next slide, please, Ella. I'll just finish off by talking through really the four types of demergers that we often think about. These, again, is like the menu list, if you like, of which type of demerger might suit a different type of situation. Now, the first one has really it's become more popular since about 2011, when they changed the rules slightly on degrouping charges. Now, if any of you have heard of degrouping charges back in your sort of accountancy days, or as you were trying to do a demerger. These could bite you. What they were designed to do was, if an asset was transferred from one member of a group to another member of a group, and then that company that was acquiring the asset left the group within 6 years, there'd be a tax charge on the market value of that asset. And it was designed to stop people smuggling assets or selling them out of a group by selling shares, let's say in a company that owns land and buildings, rather than selling the land and buildings itself, because there used to be different tax rules on that. But they changed the rules in a quite a dramatic way to help and make it easier to do hive downs of businesses or properties into a new company, and then be able to sell those shares without this degrouping charge necessarily being a problem in many cases. So that's a good one to think about in a lot of cases, because it can be quicker and therefore a bit cheaper and easier, less involved than a full-blown demerger. But in many cases, because you are basically hiving the asset down and then selling shares in a company to the same group of shareholders, that transaction happens at market value. So there needs to be, well, either a payment, or the value is left out on an intercompany account, a shareholder's loan account to the company. So it doesn't always suit, frankly, it doesn't suit all that many situations. But if you've got a business, maybe a startup division in a new company, and we can be comfortable that the value of that business we want to hive out perhaps isn't so great at the moment because it's just getting going, that's the type of situation where that can work very well. Then the next type of demerger is what we call an exempt distribution demerger. Now that's, if you like, the HMRC approved way of doing a demerger, because they recognise that in some cases the businesses that are being run by one single company are no longer suitable to be just running one company. So they've set up all kinds of rules for the SLT, capital gains tax, income tax that we've just talked about, to allow that business to be split in a tax efficient, tax neutral way. Now, the reason we'd normally look at this as the second best option, if you like, is because, again, it's slightly easier, it's slightly more streamlined way of doing things. But the flip side is that it's relatively restricted in the circumstances when you can use it. For example, as we say on the slide, we can't use an exempt distribution demerger to split an investment property from a trading company, from the trading activities of the company. We can't use it to split out businesses into different companies so that one or more can be sold while the shareholders keep one. So we can't use it as a pre-sale planning device. And finally, one always to sort of think about is that the mechanic for making a distribution demerger work is to declare a dividend in specie of the assets that's going to be demerged. And of course, that is a distribution like any other for company law and accounting purposes. So the company needs to have enough distributable reserves to do it. And in quite a number of cases, for whatever reason, when we look at the company's balance sheet, there aren't enough distributable reserves to do it. So we need to look in that situation. We then come on to the following two. Now I'll cover off Insolvency Act liquidation demergers next, the bottom bullet point, because going back, well, to before 2006, the liquidation demerger would have been the next, well, really the only final option available to us if an exempt distribution didn't work, because we were looking to separate businesses for a sale, or we didn't have enough distributable reserves. And again, I'm sure you will have heard of these in the past, and I mean, to a large extent, they are really a thing of the past now because of the capital reduction demerger that I'll talk about next. The Insolvency Act route of liquidating a company was quite involved putting a new holding company in, transferring assets around, and then liquidating that new holding company. So it was more expensive, if nothing else, because it also needed a liquidator to be involved, not just a tax advisor and a solicitor to make it happen. So, I mean, I would say, I can't. Oh no, I think about 3 or 4 years ago was the last one I did. I was going to say I couldn't remember the last one that we did. That was a particular specific example where it just made sense to liquidate the holding company anyway. And it was really less of a demerger, to be honest, although there were some assets spun out of part of it. So liquidation demergers are there, they're still available, but after the Companies Act changed in 2006, which makes it a lot easier and flexible for a company to reduce its share capital, the capital reduction demerger now is probably, you know, the most common route of demerging a business that we see. And the Companies Act, I think the key change that made this change in why we use this approach to doing a demerger is that before Companies Act 2006, a company could reduce its share capital, but it would have to go to court for that to be sanctioned, and that made the process quite, you know, a bit more difficult and more expensive. But now a company can reduce its share capital just by the directors swearing a solvency statement that the company will pay its debts for the next 12 months. And it's a much more simple, straightforward, accessible route. So that makes it easier for a company to create new share capital and then reduce that share capital. And instead of paying cash out to its shareholders, what it does is transfer the assets that are to be demerged off to its shareholders, so that you achieve the demerger that way. And again, that covers all the capital gains tax and stamp duty points that we need to look at. Okay, so I mean that's really it. Just a quick discussion of the tax matters. You need to keep a broad view of all the different tax matters, because we might be able to solve one or two, and then hopefully don't overlook the other ones that are the real issue on any particular transaction. And then we've also looked at the range really of 4 possible solutions that are available to clients to make a demerger happen. Okay, so Ella, I think if you're able to take me off, and I'll pass over to the next speaker.
Thank you, George. So when it comes to demerger, obviously it happens for various reasons, depending on the needs of the business owners at the time. And one of the scenarios is that people demerger for the subsequent sale of a part of a business, and that will be covered by Andy Humphrey, Corporate Finance Director at DT Manchester. Andy, could you please turn on your camera and microphone?
Hopefully, Ella, you can hear and see me.
Yes.
Great, thank you. Good morning, everybody. My name's Andy Humphrey from the corporate finance team of DTE based in Manchester. I haven't got any slides, but I'm just going to canter through some examples and the way in which we look at transactions and how a demerger can assist with those. So I'll be slightly less specific than George and the following speakers, but I'd just like to talk about 4 or 5 key areas that we look at when there's a reason to demerge companies. The first question we always ask is, how separable are the businesses, the companies? Do they trade together? So if we assume that there's 2 businesses, 2 companies sat within the same group, or are they separate? Is there an interrelationship between the 2? So using Fiona's example, if you've got a manufacturer and a seller of those manufactured items, if you were to separate the businesses, does it still work? Because the transactions we're looking at are not tax driven. there is a tax aspect to it, yes, but it is more a means to an end, potentially, to sell one of the businesses. So once you split the two businesses, do they, or does it, the business you're looking at, still work? And within that separation category, we also look at things like common customers, the IT. There's always ways around it, but is it all integrated? Does it need to be separated? If it can't be over a short period of time, are licenses required from each other? Larger businesses are the head office functions where there's split resource, administration, obviously, and then obviously the management of the two businesses, in my example. So we always look at that. So what we're trying to conclude is, can one function without the other? The second point that we look at is the before and the after, which is following on from the separation of the two businesses. So what does it look like now? Why are they together at the moment? Is there a reason? Is there a reason to split them up? Are they non-core? Which they often can be, or one of them can be. Are they completely different businesses? Which again, they can be. So looking back at this interreliance upon each other. From a transactional point of view, again, the reason for splitting or demerging the businesses is commercially driven. So we're looking at that rather than being tax driven. The tax is a consequence of what we're trying to do in most transactions. And lastly, on this point is the interdependency of the two businesses in question. I previously mentioned the interrelationship, but dependency or lack of it is vital. So if one can't function without the other, what are you selling? Where are you losing some value by looking at it in that particular way? So we look at all of those areas. The third point that we look at is, and I certainly won't attempt to steal Amanda's thunder, who will be coming on a couple after me, is the new and the remaining entity bankable? This is pretty vital, obviously, just from a day-to-day perspective in terms of banking the separate companies. But I guess I'm more focusing on the cash each business generates, and if there is a debt requirement on either of them. And again, looking at the modern way of funding transactions is to leverage off the assets of the existing businesses. So it's pretty important that we in corporate finance look at something like that, look at the funding and the cash. The next point we look at is why. Why is it demerged? What's the story behind it? Is there a commercial reason? We in corporate finance tend not to be looking at the personal engineering of something down the line. It's more to do with selling a different part of the business. And it can be often the case that one business is performing better than the other. And I'll come on to a couple of examples at the end. And actually, there's a reason to sell it, to invest in the business that's perhaps underperforming if there's a good reason for it. And the last area that we sort of focus on is having a good look at it beforehand, rather than doing it and then considering it. Is the demerged entity saleable? So looking at all of the aspects I've just mentioned, does it stand up? Does it work on its own? And if it does, then yeah, absolutely, we'll sort of take it down the demerged route and work with George and the lawyers and our friends in the banking arena to try and make that work. I'll try and finish with just a couple of examples of where we've seen demergers work. One example is in the demolition, reclamation, waste area. Typically, property companies have, in this space, have quite a lot of property as well. And in this particular example, there was a group of companies, I use the word group loosely, a collective number of companies where there was common shareholders. But
Thank you, Andy. So far we have talked about the financial aspects about involving demerger. The next part of the webinar will be about legal practicalities when it comes to a demerger, which will be presented by Paul Matthews from the WHN Solicitors. Paul, can I ask you to turn on your microphone and camera, please?
Thank you, Ella, and good morning, everyone. Having decided on a business demerger and the steps you want to take to achieve that, you then need to correctly document the arrangements. As you can imagine, the documentation is rather technical and perhaps is not the best of recommended holiday reading. However, it is important, and my aim this morning is to explain why that's so, and then to move on to some of the practical considerations that arise from a legal point of view when giving effect to a business demerger. So first, some reasons why the legal documentation is important. First, you need to be able to clearly demonstrate, not least to HMRC, what steps have been taken, when and in what order. Any issues with failing to do that clearly or any uncertainties could impact adversely upon the anticipated tax treatment. Secondly, you're going to want to be able to clearly demonstrate that you've complied with all applicable legal requirements, not least the requirements of company law. The various steps that George has outlined in his talk, such as capital reduction, all have a series of hoops, which from a company law perspective, it's necessary to jump through to properly deal with the matter from a legal point of view. Failure to do so could, of course, have serious adverse consequences. A good example of this relates to dividends and other distributions which may be required as part of the STEP plan. Company law imposes various restrictions on the ability of companies to declare dividends and to make other distributions. George has already alluded to the requirement for distributable profits. Why that's important is that the consequences of there being an unlawful dividend or distribution is that there may be personal liability on the directors who are in default and allow that situation to occur, and also the possibility of the shareholders who benefit from the distribution or dividend in question being liable to repay it. All of that being obviously a situation that's best avoided. Thirdly, you've heard already about demergers with a view to a sale. If the demerged entity is going to be sold, you can expect as part of that process the professional advisors of the buyer to carefully scrutinise the documentation that you've put in place relating to the demerger as part of their legal due diligence process. If that exercise highlights issues, then clearly that may lead to delay or difficulties with the sale process. A buyer is not likely to be happy with assuming potential liabilities or uncertainties as a result of flaws in the demerger process. And where that's the case, you'd probably expect the buyer to require the seller to take responsibility for that, should it happen, through providing appropriate indemnities. And obviously, from a seller's point of view, the fewer indemnities you have to give in connection with your sale, the better. So moving on to some practical issues, there are numerous practical issues that you encounter with giving effect to business demergers. Rather like with the tax issues that George has referred to, these might be more wide-ranging than you might initially think. Not all considerations will apply to every company, so it does make sense as early as possible in the process to assess the particular circumstances of the company that you're dealing with a view to identifying the issues that are likely to apply in dealing with the process so that you can get underway with taking any steps that are necessary to deal with that. So, by way of example, here are some examples of practical issues which I commonly encounter when acting for clients in connection with business demergers. First of all, it's essential to check the articles of association of all relevant companies involved. This is done with a view to establishing whether there are any restrictions which are relevant to any of the steps which you're looking to undertake. If there are, then you may need to make appropriate amendments to the articles of association of the company. A good example of this is that various steps in a demerger arrangement will involve a need for the directors of the company to vote on transactions in which they have a personal interest. If the articles of association of the company allow a director to vote and count in the quorum in relation to a transaction they're interested, then you haven't got an issue. But with many companies, that's not the case, and directors are prevented from voting or counting in the quorum in relation to such matters. That incidentally is particularly the case where the company in question relies on the model articles prescribed by the Companies Act 2006, which doesn't permit a director generally to vote on a transaction in which they're interested. The Articles of Association of a company operate as a statutory contract between the shareholders of the company and also between the shareholders and the company, and failure to comply with the terms of the articles is effectively a breach of contract situation. So it's not one that you want to get involved in. So make sure that none of the steps involved in the step plan involve anything which is going to be a breach of the Articles of Association. On a similar theme, it's also essential to check the terms of any shareholders' agreements that may be applicable to the companies in question. A common issue we're looking for there are minority protection provisions. Minority protection provisions in shareholders' agreements might mean that you need shareholder consent where the general law otherwise wouldn't require shareholder consent, or alternatively, it might mean that you need a greater level of shareholder consent than would be required under general company law. And again, failure to observe the requirements of any relevant shareholders' agreement is a breach of contract situation, leading to potential liability for those in default. So it's essential to be clear as to what the requirements are and to follow them. Thirdly, you'll need to check whether there are any charges, mortgages, or other security interests which affect any of the assets which you're looking to move as part of the step plan. If there are, then that's probably not going to be a problem ultimately, but it will obviously be necessary then in those circumstances to make contact with the lender and to find out what their requirements are. Chances are they'll want to take equivalent security over the assets in question post-transfer. On a similar note again, you need to carefully consider the title to any properties which are being moved as part of the demerger step plan. One of the key issues to look for here is whether there are any restrictions on the title which will prevent the transfer being registered by the land registry unless certain conditions have been complied with. Again, that's unlikely to be a problem, but it is important to identify what the requirements are at the earliest possible stage so that you can make contact with the necessary people and do what's necessary to make sure that the conditions are complied with, so that when you come to register the transfer, you're able to give the land registry the appropriate evidence that you've done that. You'll also need to give consideration as to whether there are any assets, contracts, intellectual property rights or services that are shared between different parts of the entity that you're demerging. If so, you'll need to think about what arrangements need to be put in place to deal with that scenario going forward. For example, you might need to put in place some sort of contractual transitional services agreement. That's of course likely to be particularly important if it's envisaged that different parts of the entity will be under different ownership going forward. Perhaps a consideration that's less obvious is the potential impact on any contracts that the entity you're dealing with has. One of the things you're particularly looking out for here is change of control clauses in the contracts and the impact of those, and looking to basically see whether any of the transfers that you're anticipating as part of the demerger process are likely to trigger the change of control clause. If they do, then you obviously need to identify that and take appropriate steps to deal with that. Failure to do so, of course, may give rise to potentially the loss of important contracts. More generally, the process involves a careful analysis of the company law requirements of each and every step in the demerger step plan. A good example here is that the transfer of an asset, which would normally require only a resolution of the board of directors of the company, may also require a shareholders' resolution if the transaction in question amounts to a substantial property transaction. As you probably know, a substantial property transaction is a transaction or arrangement where a company buys or sells a substantial non-cash asset to or from one of its directors, or alternatively, a person connected with one of its directors. And although the resolution of the shareholders that's used to deal with that may seem very innocuous when you see it on paper, and you might think it's just a case of box ticking, in fact, the consequences of failing to identify that and to deal with it appropriately can be pretty serious. These could include the transfer in question being voidable, and any director of the company with whom the arrangement's made being liable to account to the company for any gain acquired, and also being liable to indemnify the company for any loss the company suffers in relation to the unlawful arrangement or transaction. Finally, I think it's important when dealing with the various legal documentation not to overlook the impact of directors' statutory duties on what you're looking to do. As you'll probably know, a director's, for example, under a duty to promote the success of the company and to act in its best interests. And it's certainly good practice when dealing with documenting the board minutes in connection with demerger transactions, as with anything else, to make sure that they make clear that the directors have given due consideration to their duties, and where possible to record the director's thinking in terms of why what you're doing is indeed in the best interests of the company. So, in conclusion, I think the proper documenting of a business demerger requires obviously appropriate expertise, attention to detail, and a methodical approach. As I think I've emphasised several times during what I've said, in my experience, early consideration of the likely issues means that any steps that are required to deal with those can start to be undertaken at the earliest opportunity, and that, in my experience, makes the whole thing a smoother process overall. Thank you very much for listening. I'll be very happy to answer any questions arising from what I've said, and with that I'll hand back to Ella, please.
Thank you, Paul. So the next part of our webinar today is going to be about banking considerations. When we first approached Amanda from to join our webinar today, the idea is that she would be talking about banking assets after the demerger. But as Amanda rightly put, it's not just about following a demerger, but you do have to consider and do have a number of things to consider before the demerger as well. So that will be something that Amanda will cover. So I will hand over to Amanda.
Thanks, Ella. And thank you. I think there'll be hopefully some common themes that you hear throughout here. Ella, can you hear me okay and see me okay?
Yes.
Perfect. So yeah, to recap, my name's Amanda Wood. I'm one half of the job sharing relationship director team for Lloyds Bank, and I look after a portfolio of customers that turn over between 25 million and 100 million. As we're on the home straight, I won't take too much of your time. I've got a few pointers that management teams might want to consider, which will repeat some of the other earlier speakers, but also from a banking perspective when looking at a demerger. Before getting into specifics, the main point I'd encourage, and you know the other speakers have said it, is pick up the phone to your relationship team early on. They'll be delighted, of course, to speak to you, but they'll also be keen to share their experience and help with the wider project management. The first set of considerations I'd encourage teams to think about are the banking practicalities. You know, what will the business require post-separation? What suite of accounts, facilities will a standalone entity need, and where are the interdependencies? In addition to mapping out the various accounts and facilities that were required post-transaction, it can be really easy to overlook key details such as what the separated business's HMRC bonding requirement might be, or what the appropriate signing and payment mandate might look like post-transaction. In terms of the latter, whilst the preference for some businesses is a clean cut-off point, we've seen some really good example of transition agreements that work well, allowing for specific periods of time post-transaction for things like shared support function and office space even. Another linked point to consider around the practicalities are the removal and addition of account access at the appropriate course of time. And of course, also timing communication with customers, suppliers and or tenants. A change of ownership will also trigger a requirement for your bank to refresh their Know Your Customer files. And at a minimum, I'd expect structure chart will be required, providing details of the new beneficial ownership. So other speakers have touched on it, but the second major consideration that I'd encourage them to think about and engage as early as possible in the process is the bankability of the demerged entity. It's really important to understand what basis the current banking facilities have been provided on. As touched upon, there will be security required, or there might be existing security considerations that need to be taken into account. And as part of that early conversation with your banking team, it's about discussing, you know, what will they need to support a credit assessment of the demerged business. I don't underestimate the challenge that the creation of supporting information for a standalone business can bring for a business. You know, previously an entity is sat as part of a whole, and that's where I suggest that, you know, you look at this earlier alongside your advisors where appropriate, just to make sure that you've got the information in a suitable presentational form. Finally, very conscious of time, my final suggestion would be to ask your banking team for an idea of timescales involved in terms of obtaining required credit support, subsequent documentation of any standalone facilities, and also any system changes to system access that's required. That should allow you to flush out what that wider transaction timeline needs to be, and, you know, give you time to escalate if there's something in there that's a potential blocker. As promised, so with 2 minutes to go, it's just really a short overview. There's some suggested key points, but please feel free to follow up offline if I can be any help in the future. Thank you. Thanks, Ella.
Thank you, Amanda. So if nobody has any questions to ask, then I think that would wrap up our webinar today. Thank you very much, everyone, for joining us today. And we hope that we have provided you a general picture about the merger. This is a big topic, and especially because it has so many scenarios. So you might have specific questions about your own situation, in which case, please feel free to contact us. We probably will forward you the email address of the speakers, but if you have any question at all, please send them to marketing@ddgroup.com, and I will forward them to the speakers that you would like to speak to. So once again, thank you very much, and I hope you have a good day. Bye-bye.